So welcome to the latest edition in the Crisis Talk series by Global Capital, the foremost information source on the international capital markets. Since the outbreak of the COVID-19 pandemic, Global Capital has been speaking to senior figures in the capital markets on how they have been coping and navigating through the crisis. I'm delighted to be joined today via Zoom by Siegfried Ruhl, head of funding and investor relations at the European Stability Mechanism, the institution that was set up in 2012 to help Euro area member states in severe financial distress. It was actually initially created as a backstop for those member states that were unable to access the capital markets during the Eurozone sovereign debt crisis. So welcome, Siegfried, and thanks very much for joining me. Firstly, how does this crisis compare to the Eurozone sovereign debt crisis, or indeed any other crisis that Europe has faced?
Yeah, hello, Borhan, and thank you for giving me the opportunity to talk in your crisis talks. Well, the COVID-19 pandemic is a crisis like none other. Not only for Europe, it's different for the whole world. It has caused huge economic damage. And one example, last month it was reported that the UK GDP dropped by a record of 20% in April. Also in Europe, economic growth will sharply decline in 2020. The IMF economic outlook suggests at the moment a 10.2% decline in euro area GDP this year. The economic decline is not the only aspect of this current crisis that is different to the past. The nature of the crisis is different too. Some people ask if there are parallels to the euro area sovereign debt crisis we faced around 10 years ago. Yet there are no parallels. The crisis in 2010 affected certain countries within the euro area, but not all of them. It was often the result of economic imbalances and weaknesses stemming from unsustainable fiscal policies in that era. Now, the current crisis is indiscriminate. It affects all countries of the euro and the wider European Union and beyond. All crises have to deal now with the tragic loss of human life and economic costs. Yet also, none of our member states has lost market access so far.
Okay, great. And obviously ESM's role is at the center of helping Europe through this crisis. Could you outline the ESM's pandemic crisis support?
Yeah, well, the crisis support or pandemic crisis support line, how we call it, of the ESM is part of a wider package. In April, the Euro area finance ministers decided on a package with three elements. There's first the so-called SURE program of the European Commission to support the workers. Then we have the European Investment Bank supporting the SMEs. And finally, the pandemic crisis support provided by the ESM. Altogether, this package amounts to 540 billion euros. Now, what is the ESM part of this? The pandemic crisis support is a credit line based on an existing instrument which was created at the beginning of the ESM, the so-called ECCL or Enhanced Conditions Credit Line. Since May, we have, based on this ECCL, created the pandemic crisis support, which is available to all 19 euro area member states. And it has only one conditionality. The money has to be used for direct and indirect healthcare costs to fight the COVID-19 crisis. We can lend up to 2% of each member state's GDP to the member state to support the member state in dealing with the crisis. The loans we provide to the member states can have an average maximum maturity of 10 years. If we take the 2% for each member states, then in case all 19 member states would request it, this sums up to an amount of up to 240 billion euros.
Okay, and how does a member state go about applying for the ECCL?
Well, as said, this pandemic crisis support is based on the ECCL, and in general, the process follows the process of the ECCL. Nevertheless, the European Commission already carried out a pre-selection exercise and determined that all 19 euro area member states are eligible for our assistance via the pandemic crisis support on standardized terms. Now, if a member state wants to receive the pandemic crisis support, it must provide its submission to the ESM Board of Governors, comprising the 19 euro area finance ministers. The Board of Governors then need to unanimously endorse this application. And while this endorsement is based on the board being satisfied that the proceeds will be used to fight the COVID-19 crisis to finance direct and indirect health costs. Once the PCS, the pandemic crisis support, is approved, the member state still can decide if it wants to draw on the line or not. There is no must, there is no obligation to draw on the line. But if the member state decides to draw on the line, then it can get 15% of the total amount per month, which means in around 7 months, the full line can be dispersed to a member state. The member state can here include any backdated relevant healthcare costs since February 2020 and 21. And the member states can apply until end of 2022. And then the line is always given for 12 months. And this period can be extended twice by 6 months. So total availability period, the maximum one is 24 months.
Roughly how many member states do these lines represent a cost saving for?
Under current market conditions, 12 of our 19 member states would benefit from the pandemic crisis support. Means they would fund themselves cheaper via this PCS line than they do in the markets. The 12 member states, the total amount would be in the area of 80 to 90 billion euros. For them, it would be an incentive to draw on the credit line. Some of them pay 1 to 1.5%, for example, for a 10-year issuance at the moment. Funding via the ESM, via the pandemic crisis support here for 10 years, the rate would be around 0. And would we fund in the area of 7 to 8 years, what is our current funding structure for our outstanding debt, then the rate would be even negative, means they would be paid for taking money from the ESM. So it's a real incentive for them. It would mean saving taxpayers' money. Some of them could here save over a period of 10 years up to 6 billion euros. How did we achieve this? How did we lower this funding cost to these attractive levels? Well, on the one hand, on the administrative side, we reduced the costs. The margin was reduced to less than a third, to 0.1%. The one-off service fee was reduced from 0.5% to 0.25%. And the annual costs, the annual service costs, are just 0.005%. On the other hand, on the costs of our own funding, here we created a separate funding silo to separate the costs for the funding of the pandemic crisis support from our outstanding debt. Means it will not be impacted by what we have issued in the past. Member states can fully benefit from the current low and negative interest rate environment. This means the creation of the pandemic crisis support with these attractive funding conditions is a real example of European solidarity. Using the pandemic crisis support means saving taxpayers' money. And while the financial sector 10 years ago was the cause of the problem, now the financial sector with such attractive products can contribute, can be part of the solution of the problem.
Okay, and you recently published your social bond framework, which will be used to fund your pandemic crisis support. Talk to me why you decided to issue social bonds and when you expect to um, start issuing the first social bond.
Well, the ESM always was an advocate of the environment, social and government principles known as ESG. As an institution and as an investor. For example, in February this year, we signed the United Nations-backed Principles for Responsible Investment. So with our investment of our paid-in capital, we follow the 6 ESG principles and are part of a network now of more than 2,900 investors who have signed up to the UN PRI from over 50 countries representing more than 90 trillion US dollars in assets under management. On the funding side, we also are looking for a while at ESG topics. Since last October, we are a member of the International Capital Market Association's Green and Social Bond Principles Advisory Council, and we already looked at the possibility to issue social bonds. Now, with the new pandemic crisis support, we are also able to do so, because here we have a clear definition of the use of proceeds. So now over the last weeks, we worked on the social bond framework, and end of June, we published the ESM social bond framework. It's compliant with the latest version of the ICMA social bond principles, which were also published in June. Our social bond framework describes the 4 principles: the use of proceeds, the process of project evaluation and selection, the management of the proceeds, and the reporting. Means, should now countries apply for pandemic crisis support, we will be able to issue social bonds under the social bond framework. This will also further underline the social character of the pandemic crisis support. When countries apply for the credit line, they have to agree on a pandemic response plan. And in this document, it's very clearly stated how and for what the funds can be used. There are 3 categories for the eligible social expenditures. First, these are healthcare, cure and prevention costs directly related to the COVID-19 pandemic. Then we have the part of overall healthcare spending estimated to be directly or indirectly attributed to addressing the impact of COVID-19. And we have other indirect costs related to healthcare, cure and prevention to the COVID-19 crisis. The ESM will work closely with the European Commission to monitor the use of proceeds, and based on that, we will also report to our investors about the use of proceeds and the impact. This monitoring will be published on our website. We will report up to 1 year following the issuance of the first social bond, and then every year until the proceeds are fully allocated. With this approach, we can make use of social bonds as an innovative debt instrument, allowing the investor community to allocate their funds to the social needs of Euro area member states. It also is our objective to support the development of this young market. And as mentioned, it underlines the social nature of this ESM support of the new product of the pandemic crisis support.
Okay, great. And do you expect the ESM social bonds to be priced tighter than the conventional bonds?
Well, from a credit perspective, the social bonds are not different from our, let me call it, conventional bonds we are already issuing. There's no difference. So the secondary market curve of our outstanding debt should be the first pricing reference for ESM social bonds. The social bonds benefit as our conventional bonds from our strong rating, the AAA rating with stable outlook from Fitch, and the AA1 rating from Moody's. Nevertheless, the social bond framework makes our bonds maybe more attractive for some of our investors, or will bring even new investors to our books. So there is a possibility that ESM social bonds can offer a cost advantage, yet it's a bit too early to say. This needs to be seen once we are issuing social bonds to the market and once they are traded in the market.
Okay, and will ESM continue to issue social bonds after the pandemic is over?
Well, first, it depends very much on how the COVID-19 crisis develops, and first we need member states to request the pandemic crisis support. The fact that we issued a social bond framework already indicates this is not a one-off exercise. And the maximum average maturity of the loans of 10 years gives us the possibility to issue then social bonds over a longer period of time. We have chosen a portfolio approach, means as long as we have social loans outstanding, pandemic crisis support outstanding, we can fund this by issuing social bonds. And this shows that we will not be active only for 1 or 2 years. We will be active in the social bond market once we have started for a longer period of time.
Okay. And will ESM continue to make use of its existing funding instruments, for example, the bill programs you have and the dollar program?
We will, of course, continue with our outstanding products, with our existing products. We will continue with our bill auctions. We just added the 12-month bill line in April this year and provide here on a monthly basis via auction liquidity to the market. And we also have to roll over our existing debt. So we will continue to issue the conventional products, our benchmark bonds, liquid benchmark bonds, new ones, tap off existing ones, and we will continue our presence in the dollar market, of course.
Do you expect ESM's funding program to increase in size?
Well, what we have currently announced for the ESM for this year is 11 billion. The 11 billion are needed to roll over our existing debt which matures during the course of the year. Should we receive a request for a pandemic crisis support, this will impact our funding plan, and we have to increase our funding plan depending on the size of the request. As in the past, transparency is crucial for us. We always communicate very transparently about our funding plans and funding needs. And so should we receive a request for pandemic crisis support and we have to amend the funding plan, we will communicate this also transparently to the market so that everybody has a clear view what can be expected from the ESM.
Great, thanks very much, Siegfried. All of our Crisis Talk interviews are free to read and you can find them online at globalcapital.com. In addition to this interview with Siegfried Ruhl from the European Stability Mechanism, some of our other recent interviews include the likes of Bertrand de Mazière, the Director General of Finance at the European Investment Bank, and John Hempton, the Chief Investment Officer of Bronte Capital.